just saying to us that we've seen this data coming out of China. It looks a bit weak, but you say you're too tough to be scared.
Oh, okay. I'm too confident. Put this way, the data doesn't mean so much when it comes to making investment decisions. We more look like the future opportunities. So in the coming 3 to 6 months, I call that this market is bottoming out, and we should now.
Hang on, you said it was bottoming out earlier this year.
No.
I'm sure you said that to me in January.
Okay, if you say so, let's follow this. I became very cautious last October, November, and that's why I even made in my view in the public. I shorted the Hang Seng Index at the 24,900 level. I should say this all the way. So I made roughly 3,000 points profit. So you have to take a wheel. And so on 18th, 19th of June, I covered all my short position when the Hang Seng Index trading below 21,900. So
that's more or less exactly what you said that you were going to do, I think, when I talked in January. I mean, so I'm not really contradicting you. But you're saying it's bottoming out now,
maybe
though.
My English is not so good yet.
Yeah, I'm sure.
I have to improve that.
Yeah.
But the point is, now, this month and the next month, it's very likely the market will turn around. I mean, investors will jump in. Why? Number one, there are flooding of money coming once the debt ceiling to be lifted up, okay? And the U.S. is too big to fail. So some liquidity is coming this way, and the Greater China, it is the next decade investment returns heaven. Okay. Number two, Chinese stocks are oversold. They have been oversold for so long, and they're so depressing. It has been led by the government toughing. Our government much tougher than me, okay? Decisions.
I want to jump in here quickly because I was reading through the research beforehand, and you said investors are ignoring the stock fundamentals at the moment and paying more attention to the macro situation.
Yes. Until today, it's still the case.
And do you think that's why the market, perhaps in China or here in Hong Kong, is not on this dramatic upward trajectory that we've seen in the past?
Global investors, their behavior has been changing so much after they getting hurt in the financial crisis back in 2008. So everybody look at the headlines. So you guys' job become more appraised, appreciate, I should say. Okay,
appreciate
both ways is good. Okay, so basically the headlines has been dominating investors' behavior. Who cares about the CPI data? Otherwise, who cares about the unemployment rate in the U.S.? Otherwise, why the market continue going up?
Liu, people do care because they're spending that much more money on very meager salaries, which you claim are increasing, but their food stuff keeps on going up. I mean, it's a bit of an indictment when we've got people coming from mainland China to Hong Kong to buy food.
Oh, then Hong Kong will be finished in one day. Okay, so basically, as long as, the government cares about the people working on the street, whether they have a better life day by day, whether they can afford their kids' education, their healthcare expenses, and whether at the end of the day, China can move into the right direction without any social interruptions or social disturbance.
Your investments, I mean, the bottom line is that there is debt in China, there is debt in the US, there is debt in the Eurozone. It's never going to go away. It won't be overnight fixed. That's the bottom line. That's the background to all of this. So to say the markets are going to rise is a big call. I mean, someone was saying today from SocGen to me that valuations are very low. Buy stocks second half.
I think that they make the right call.
But surely with all this background of debt, it is a dangerous climate to take a risk on.
Okay, it seems like, put this way, it seems like the market has been focusing on debts so much. It seems like all the major rating agencies really scaring us, changing their views towards what all the, PIGS countries, whatever, even move to China, derating on, about the debt levels. It seems like tomorrow, the whole world debts will all become rubbish level. So,
yeah, right.
So basically, my knowledge, is beyond to understanding Moody or Standard & Poor's, their view towards rating debts. But the point is, the world has been changing so much. We are getting stronger. We are getting smarter after 2008 financial crisis.
On that smart line then, which investments are you moving for the second half of the year? Is it high-yielding bonds? Is it emerging bonds? Is it stocks? Is it commodities?
Stocks look like very, very cheap. I'm talking about
in Hong Kong.
Yes, I'm talking about all the ethnic Chinese communities. We have the similar view towards politicians, towards consumer consumption, towards the education, whatever. So basically, the Greater China Yuan will become. We are the largest creditor and the largest saver in the world. Okay, now, so we on the debt level or the credit level, we almost own the whole world, half of that. Because the way, has been like this. So U.S. or Americans or whatever, they are facing major problems, but it's too big to fail. In other words, the sovereign debt ceiling will be lifted up in just a matter of weeks or matter of days. In such a world, no matter the fundamentals, CPI, the market will go up. So second half, I come to your question. We buying the things which benefiting not from debts at all. Forget about debts now today, okay? We're benefiting from the future's economic growth instead of focusing on the best part of the society, which we work hard, we study hard, we earn money, then we start to, enjoy a better life. In other words, anything related to middle class themes. When you run a bank, 20-80 rules. So you have to focus on the 20% first.
Liu Yang, I would just bring in Zeb very quickly.
No, I think this point you're making about rising affluence, rising wealth is very pertinent because it will have an impact, dramatic impact on the Chinese economy, the global economy, and the standard of living there in China. You look at the rising wages in China, it's going to make a huge difference.
This is what we're talking about. In the last 5 years, the wages growth has been rising and moving forward by 15% compound ratio. I don't believe any other country can run that fast to catch up China. So we are not only tough, we are moving fast, we learn fast. So coming back to you, when we play the China or Greater China game, and we have to forget about the global policy-driven effect for a little while because all the government jump in, want to do something. We come back to see the real Chinese life.
Thank you very much. Liu Yang there, just from Atlantis Investments.